Hello everyone, welcome back to the show. Thanks for tuning in. My name is Mike, this is my whiteboard, and today we're going to be talking about how broken wing butterflies, which is basically a standard butterfly where we take one of the sides and make it wider than the other, and we're going to talk about how we can close that for a debit or a credit, depending on the situation in that trade. So let's go into the first side and we'll talk about the broken wing butterfly and really what it all boils down to. So like I said, a broken wing butterfly is just a butterfly, but instead of having equidistant wings, we basically are extending one of the wings, which ultimately removes the risk from the other side. So if we want to imagine this with a put butterfly, basically what we'd be doing is looking at a butterfly that's out of the money, which just means it's a butterfly that's below the stock price. And instead of having equidistant wings, where my long put would be somewhere right about here, I'm actually going to move that long put a lot further out of the money, which ultimately gives me a larger credit on this put vertical that I'm selling against the debit that I would pay for this long put vertical. So ultimately what this does is it allows me to route this trade for a credit, which is going to remove all of the risk to the upside here. Because with a normal butterfly, we actually have to pay for it, which means that if the stock price stays up around here, we're actually going to lose that money that we paid. But if I collect a credit to open this trade, anywhere above here is going to be profitable. So again, by breaking the wing on the credit spread side, we route the trade for a credit, which ultimately eliminates the risk on the opposing side. So if I'm breaking the wing on a put butterfly, it's going to be the downside wing, which eliminates risk to the upside. If I was looking at a call butterfly, I would eliminate the risk by breaking the wing on the upside, which would eliminate the risk to the downside. So basically, to break a wing on a broken wing butterfly, all we're doing is moving that long option that we're purchasing further out from where that stock price is on either side. So we're going to move that wing, we're going to collect a larger credit on this short put vertical here than the debit we would have to pay on this long put vertical there. And that's how we route that for a credit. So because we have this assumption and we're actually routing this for a credit, we can be profitable in a ton of different ways, but ultimately, to reach max profit, we want to have the stock price drop down to our short strikes at expiration, because that's where our max profit is going to lie. So for that reason, we actually have a neutral to bearish assumption. If we route it for a credit, we don't really care if it stays up around here, because we're going to be able to collect that credit and keep that as profit. But ultimately, we want that stock price to go down, which is why we really want that bearish assumption and why we want that stock to go down to reach that max profit. And ideally, implied volatility environments is going to be the highest one. So when we're looking at when we would route this trade, usually high IV environments are going to make it a lot easier to route a trade like this for a credit. When we're in lower IV environments, we might have to move that long strike out there even further away than in a higher IV environment. So it's really important to really ensure the fact that we're looking at these high IV environments. And also when we're talking about buying this back for a debit, if we're selling this in a high IV environment, it gives us another way to be correct when the implied volatility comes down. So that's exactly what we're going to talk about on the next slide. We're going to talk about what we can do to buy this back for a debit. So ultimately, what we need to realize is that with standard strategies where we're routing them for a credit, we always buy them back for a debit to close. So if you think about just selling a naked put, we would want to buy back that naked put for a lower price to be profitable on that trade. Same thing with something like a vertical spread or even an iron condor. When we sell something, we have to buy it back to close that trade. But in this situation, it's a little bit different. So there's two ways we can route this. The very first one is how we're going to walk through how we can close this for a debit. So this is going to be pretty much your standard situation where we're selling this butterfly for a credit and we're going to buy it back for a debit. Well, ultimately, in order to do this, we're going to want the stock price to stay above our strikes. So if the stock price stays anywhere above this strikes here at expiration, we're going to be able to buy this back for a debit, or we can even let this expire. That's the beauty of this trade and why it's literally one of my favorite trades, because there's just so many ways that we can be correct. So if we're looking at the spread right here, the stock price can go all the way up here. There's really no cap to the upside. And ultimately, what's going to happen is our options are going to lose value the further away we are from the stock price. So the more the stock price rises, the lower the values of all these options will be. So if I routed it for a credit, it gives me the opportunity to buy it back for a debit. So what we want to see is the stock price to stay above our strikes. because at the end of the day, options are going to decay over time. So if the stock price stays right here, all of these options are going to have a theta value assigned to it. So with short options, we have a positive theta because we sold those options here. We want the options to decay to be able to buy them back at a lower price. But with long options, we're going to have a negative theta because if I bought an option, I want it to increase in price. So the fact that it's going to decay over time is actually going to be bad for that position. However, I'm routing this trade for a credit, so we have to remember that. Since I'm taking more risk on the downside here and breaking the wing on this short put vertical, compared to the debit I would pay for this long put vertical right here, since I'm collecting more and I'm really ultimately turning this trade from a debit into a credit, my positive theta that I'm going to see on my short put spread is going to outweigh the negative theta that I would see on my long put spread. So at the end of the day, this trade, especially if the stock price stays right here, is going to be a positive theta trade because it ultimately allows us to be able to either buy it back at expiration or close to expiration for less than what we collected originally, or it allows us to just let these expire, which would bring in that cash that we originally collected, and once the trade disappears, that cash would turn into full profit. And the third option we have to really close this for a debit is for if implied volatility decreases. So what will happen then is if implied volatility is decreasing, really what it is reflecting is the action in the option market. So if implied volatility is decreasing, that must mean that the option prices for these strikes are also decreasing. So if I sold this spread for $1 and implied volatility has decreased enough for me to be able to buy back the spread for 50 cents, that's just another dimension to the trade and another way that I can close this for a debit and a profit. But there is another way that we can close this trade, and that is for an actual credit. So even though we sold it for a credit, we can actually close out of this trade for a credit as well. It's a little weird, but we're going to walk through it on the next slide. So what we need to realize is with this strategy, we do have a long option that's going to be profitable if the stock price goes down. And that's this option right here. So when we're looking at ratio spreads or broken wing butterflies, a ratio spread would just be if I were to eliminate that long option right there, where I would have a long option here and two short options against it. It's very similar, but it has unlimited risk to the downside since we would have that short put. So basically a broken wing butterfly is essentially a defined risk ratio spread. That's the way I like to think of it. So what would happen is to be able to close this for a credit, what we need to do is basically have the stock price go down. Because at expiration, if the stock price is right here, or maybe right about here, anywhere above those short strikes, basically what's going to happen is these two options are going to expire worthless because they're still going to be out of the money. And this long option down here is going to expire worthless because it's also going to be out of the money. But this option is going to be at intrinsic value. It's going to have intrinsic value. So the further down this stock price goes, as long as it stays right in this range here, we're going to see profitability on that long option. And that's where we can really close this trade for a credit. Because if the stock price is anywhere around here, let's say that there's a 5-point difference between these options here. So let's say this is a 100 strike put and this is a 95 strike put where we've sold two of them. If the stock price is at 96, what we're going to see, especially at expiration, is these two options are going to be worth next to nothing. This one's going to be even worth less because it's further out of the money, but this option is going to be trading for at least $4. Now, how do I know that? Well, I know that for a put contract, intrinsic value is going to be realized when the strike is above the stock price, or if the stock price is below the strike. So if the stock price is at 96 and I have a long put here at 100, I know that this put is going to be trading for at least $4. So even if I collected $1 for this strategy, if the stock price is right where we need it to be near expiration, I'm able to actually sell out of this option for close to $4 or a little bit more than $4. But what I have to keep into account is the fact that the further away from expiration we are, these options are going to be really hindering our profitability on this option. So the closer we get to expiration, the better we're going to be in a position in terms of closing that out for a credit. So really what we want to review is that the stock needs to go to our short strike or close to our short strike for us to be able to close out this trade for a credit, even though we routed it for a credit initially. And the closer to expiration we are, the more profit we will see. And it's all about intrinsic value. I actually have a strategy on in Tesla, the exact same strategy. I routed for, I believe, $1.23. So I have the ability to buy it back for 60 cents, and that would reap 50% profit, so right around 60 cents or $60. Or which is more likely that's going to happen, that I'm going to let happen at least, is I'm going to hope that the stock price comes back down. I'm really not trying to manage a trade like this because I actually want the stock price to go down. So if the stock price stays anywhere above here, I'm going to be totally fine with that, and I would rather have these options expire out of the money and collect that total credit that I've received. So ultimately what I want to happen is I would want that stock price to go down closer to my short strikes near expiration. Now it is pretty rare because we need both of those things to be correct. We need our stock price to be right where we want it, and we also have to be close to expiration. So it is pretty rare for this to happen, but the closer to expiration we are, the more profitability we're going to see. Because again, this option is going to be trading for intrinsic value, which is going to be great. And these options are going to be more and more worthless the closer we get to expiration. And really, that's what we want. We want this option to be worth as much as possible, but we also want these options to be worth as little as possible. Because at the end of the day, I sold these two options. So I sold them here. I need them and want them to go down in price. And the only way that's going to happen is if we are close to expiration, if we're right in this range, or if the stock price is anywhere above that, if we're not close to expiration. And again, really, profit is from the long option. It's not going to be from this spread. So we have to realize that we really want the stock price to be by our short strikes and not really anywhere below it, because our max profit is going to be realized if our stock price is right here or just above it, because we want these options to expire completely out of the money, as well as that long option there. And that's going to leave just this long option, which we can close out for a credit. So that's exactly how we would route this trade for a credit, and also hopefully route it for a credit to close as well, which is going to put us in a great position for profitability. But let's wrap all this together with some takeaways for you. So the first takeaway is broken wing butterflies are just awesome. These are one of my favorite strategies. I have a couple trades on right now, and 2 of the 3 trades I have a broken wing butterfly in the underlyings. I believe I have a put butterfly in SPY as well as a put butterfly in Tesla. And really, I love these trades because there's so many ways to be successful. As we just talked about, we can have the stock price stay exactly where it is. We can have it go up, which is very similar to a standard short put or short put vertical. But ideally, we can also have it go down to our short strikes, and it gives us an opportunity to take this credit trade that we've routed for a credit and ultimately sell it back out to the market for a credit as well. So it's a little backwards when you think about it, when you're learning about how when we sell something we have to buy it back. But once you really dial in and realize that that long option is really where the profitability is, that's where it kind of turns the light on and really makes you understand how this trade can be routed for a credit and also closed for a credit. So if you have not been keeping up over this past week, this is actually going to be the last Mike and his whiteboard show. I'm not going off the air. I'm simply transitioning into a new show with Jim Schultz, who is coming up next. But really, where should you go from here? I've done 163 segments on Mike and his whiteboard, and I am 100% confident that if you have anything that you want to learn about, whether it be strategies or concepts, I've already covered it, and you can go back and check out the archives. And my show is always going to be on. Go to find shows at the top and then scroll down to Mike and his whiteboard, and you'll see all 163 episodes there. But I do have a few other recommendations that I'd like to point out. The very first one is Bat First Bat. So Nick and Tony are awesome, and they're managing their current portfolio, and really a lot of questions we get through the support channels is, how can I manage this, or what should I think about as I'm managing this position? And really, when you're looking at 2 experts trade and manage their professional portfolio, what you're going to do is you're going to learn a lot just from watching them do it, but ultimately you can also follow along, just like the follow page. Nick posts almost all of his trades, or ultimately all of his trades, on the follow page, and I believe he's the #1 trader. So he's got a ton of volume on there, and really what you can do is follow along if you want to, whether you're trading paper or real money, and ultimately that's going to give you a good experience through just the trading life cycle and what happens practically with trading. And also be sure to check out mine and Jim's new show. So that's going to be starting in a couple of weeks, hopefully. And we're going to be talking about a lot of the same stuff, but we're also going to be trading in dough, just like Ryan and Beef do every single day. And I would also check out Skinny on Options Math. So when I was first learning, I understood a lot of the concepts, but I really wanted to dig into the math behind it. So Skinny on Options Math is an older segment, but it's a great one, and I always refer back to it when I'm looking for that mathematical side of things. So definitely check that out, as well as our other Skinny segments. We've got Skinny on Options Data and Skinny on Options Modeling. So be sure to check those out as well. And ultimately what you need to do is trade. So if you don't have an account, you can trade paper money, and if you do have an account and you're willing to trade, you can definitely go in and just dive in. I firmly believe, and I was told originally, that you're going to learn the most when you're actually trading. So that's what I did, and I really did learn the most from that. So before we hand it off, I wanted to give a big shout out to everyone in production, specifically AC, Beth, and Adrian, for making this show possible, and Doyle, who's behind the camera, and he's been behind the camera every single segment. And specifically, I wanted to thank Thomas and Cassie in animation, who really had made all of this possible and really brought that visual aspect to this show, which is why a lot of beginners and intermediate traders love it so much. So thanks so much for tuning in. If you got any questions or feedback, I'll always be on support@dough.com or support@, or you can follow me at DoughTraderMike on Twitter. Stay tuned though, we got Jim Schultz coming up next. Hey everyone, thanks for watching our video. Click below to watch more videos, subscribe to our channel, or go